So on today's video we talk all about mortgages and specifically the mortgage on your own home. Should you pay it off? Should you keep it? Many of the British market are obsessed with owning their own home, but also equally obsessed with paying off their mortgage. So we talk in context with property investment all about whether you should pay off your mortgage or whether you should keep it. Welcome back to Property Insight. My name is Mark Ashworth.
And I'm Neil Harding.
So, should I borrow more on my mortgage or should I pay it off, or what sort of attitude should I have about my mortgage? I think this is something that comes up regularly, certainly in my network. We talk often about whether or not people should pay off their mortgages, and I hear it probably more from non-property investors, to be fair. So obviously we are going to talk about this in a property investing scenario, i.e. where you've got an interest in buying property for wealth building or to replace an income perhaps. Many people over the lifetime of a mortgage will greatly reduce the mortgage borrowing by the value of their property going up in line with inflation and house price increases. So maybe, many people who had their mortgage for maybe 10, 15, 20 years might be seeing a potential of like only a 20 or 30% loan to value left on their property, for example. But yet they'll go and borrow a load of money to buy another property on a buy-to-let mortgage with a higher interest rate. So where do we see that? What's the sort of general feeling and attitude of using the equity in your own home, let's say?
There are two big things I'm thinking of here. One is the pure, the accountant in me just wants to look at the numbers.
Oh, you're so boring, Neil.
Yeah, I know, right? And just looking at the numbers, borrowing money on your own home has to be, and probably has been for many years, the cheapest borrowing you can get your hands on. And if you can put that money to better use elsewhere, and you're doing so in a sensible, de-risk, calculated way, and certainly if you know what you're doing and investing, you're a sophisticated investor, there's a lot to be said for that. And then the second thing is, and I'm no exception to this, I've been programmed from a very young age to pay off the mortgage on your house as quickly as you possibly can. And there's some sense to that as well. Because getting mortgage free is like a dream, isn't it? That's what everyone's trying to get to, isn't it?
Apparently, yeah. Well, I also remember having a conversation with somebody. I think they were business minded or entrepreneurial, let's say. And it was not long after I started my own business, which would have been in excess of, let's say 20 years ago. And they said, you want to be borrowing as much as you can possibly afford as young as you can afford it. So you want to buy the biggest possible house at the most amount of money that you can afford as young as possible. Because ultimately, the reason why that is, of course, is that even though it's difficult at the beginning, it gets a lot easier as you get older. So the earlier you do it, the earlier it gets easier. And obviously, naturally, if you're buying a property that's high value and you bought it 10 or 15 years ago, clearly the amount of increase in value, so we talk a lot about house prices going up in percentage terms. So let's say house prices go up, let's say be conservative at 5%. Well, obviously 5% on 500,000 or 1 million or 2 million or 3 million is obviously going to be an awful lot more increase exponentially, let's say compounded over a period of time than it is if you buy a house for 100,000, let's say.
Yeah.
In terms, then that comes with the benefit if you potentially build in quite a lot of equity in your own home, which could be put to good use. And obviously the banks love equity in properties, don't they? Because it just makes the whole thing very safe. I've always found it really interesting that mortgage lenders will go to the nth degree to check out your criteria when you first take out that mortgage. But if you've taken it out for 5 years, they never come back to you, do they, and say, we're just checking you still got that job. Are you still employed by the same company? Or have you started your own business now? They don't ever come back and ask you those questions. All they care about is that you pay the mortgage, right?
Yeah, that's right, yeah. Very limited due diligence done or check-ins done, is there, in years 3, 4 and 5. Yeah.
obviously we go to a lot of networking events. I run a networking event in Cambridge, and we go to various other ones. You go to a few in Peterborough and whatnot. The question does come up about borrowing money on your own home and whether or not it's a sensible option. Well, I think it depends, and I think it's probably well worth saying that this is not financial advice, and that you must make sure that it's affordable, and you must do it in a compliant way, which means that you need to make sure that your lender is okay with it, and that you're using the money for, and what you're using the money for, that you're honest and upfront about it, and naturally use a decent broker as well. But I think that if you've got equity in your property that you can release to potentially, even if it's pay down some of the loans on your more expensive borrowing, because buy-to-let mortgages, particularly in limited companies, are quite a bit higher than your own home, residential homes.
Absolutely, yeah. The accountant in me that wants to look at the spreadsheets and look at the numbers just thinks, if I can borrow money against my main residential property at, 3%, and either pay down a mortgage that's costing me 5% or more elsewhere, why wouldn't I do that? Or if I can borrow money at 3%, with the same logic of when you're looking at a buy-to-let investment, if you can borrow money on a buy-to-let mortgage at 5%, but you're going to make net 10% or 7% or something like that, then it stacks. Well, equally, if you can borrow money even cheaper than 5% against your resi house, well, why not use that money? Then your margins are even better. I think, though, that's almost a leap of... It's a leap, isn't it? You've got to sort of be really confident in what you're doing, I think, and in property investing. And ultimately, you want to be able to sleep easy at night and be comfortable with what you're doing. And people's main residence sometimes has an emotional pull on you as to whether or not you want to take a second mortgage or increase your balance. But if you've just spent 20 years trying to pay your mortgage down on your main house, and now you're starting to think about increasing it, it doesn't always sit right with people.
It's almost, though, that people are kind of disjoint. Their investing journey, they're buying their property investments for wealth from their residential, in the sense that, it might be really good if I could pay down my home mortgage. But I'm quite happy to have all these other mortgages associated with my buy-to-let portfolio, which I think, maybe it's just we're suggesting that perhaps you take a more holistic approach to the whole thing, your whole borrowing, in one, rather than having this separate and that separate.
Or if you take mortgages within your limited company, you're probably giving personal guarantees against all of those mortgages. Yeah. And if you don't pay them, then ultimately your own house is probably on the line anyway. But of course, people tend not to really think about it in that way. They still think in a compartmentalised way. Well, this is the mortgage on my main resi house, and this is and that's just, I think that's a bit of a human nature thing. But yeah, it's interesting.
So I think, so in the general scheme of wealth building, and certainly when it comes to purchasing property and raising finance, whether it's through private investment or whatever, we're probably just saying, have a look at the whole picture, have a look at the whole of your assets, and see whether or not it would be worthwhile chatting with a broker, at least, just to see whether or not that releasing some equity from your own home could be a way of actually borrowing money cheaply. I know of a couple of people that have certainly done that, and whilst they had initial reserves in their mind about doing that, based on the whole kind of like, do we really want to do that in our own home? I think actually when they realised that all of their mortgages from their limited company were backed up by personal guarantees, I think that they realised that actually it was a much better prospect once they realised that by doing that they could actually get a pretty decent rate on that borrowing. So yeah.
You mentioned speak to your mortgage broker. I think just to caveat everything that we've just been saying, definitely recommend speaking to a mortgage broker. If you are thinking about using borrowings from your main residential property for investment purposes, then make sure you're transparent in any application that you do for that. Make sure that the lender understands that is your intention and what you plan to do with the money. Otherwise, of course, you do run the risk of mortgage fraud. So yeah, absolutely speak to a mortgage broker and take advice on this.
Would you say that it's probably something for a more experienced investor to look into? But
I think it's possible for both a first-time investor and an experienced one. I think it's a way of raising finance, and ultimately you've got to be comfortable and knowledgeable and doing it with a level of skill that you're comfortable in what you're doing. I don't know if it's I wouldn't say it's first choice for the first time investor as a way to raise money. It is an option, but not necessarily first choice.
Yeah, because there are some other factors as well. So the lender, whoever's lending on that, whether it's a second charge or whether it's a further advance from your current lender, they'll obviously want to check affordability. So they'll need to check, if you are running your own business, they'll need to check your accounts. If you're working for somebody else, you'll need to be able to provide pay slips and whatnot to be able to prove that you can afford to pay it back. And the other thing is that it's unlikely that you'll get an interest-only product. It will almost certainly be capital repayment. So therefore, you'll be, your mortgage payments will be fairly high, and it's likely that will have a term on it as well. So it could be 2, 3, 4, 5 years, whatever. Might depend on the existing product that you've already got on your property, or if you don't have an existing product, it could actually work in your favour to go and renegotiate on a new product. Don't just slip into the normal standard variable rate that most lenders will drop you into once your term's finished. We hope that you found that video insightful, and please don't forget to like the video, so give it a thumbs up for us. Also, any comments about the video below, we'll try and get back to you, and of course please subscribe to the channel so we can bring you more content like this. I look forward to seeing you on the next one.